My name's Gavin Martin from Cornerstone Wealth. This is the Christian Super Centrelink Income and Asset Strategies webinar. Thanks very much for joining us. Just a disclaimer that tonight's information is advice of a general nature. Please seek personal financial advice before making any decision. If you would like us to assist you with personal advice, the way we do that is have you complete a questionnaire. That enables us to hit the ground running in a discovery meeting where we understand your goals, look at your current situation, and then talk through the pros and cons of the range of options available to you. That's still general advice. If you want to go to the next stage, then we can give you specific recommendations. We need to do that in writing in the form of a statement of advice. We can also help you implement it and provide ongoing advice as well. So you can take the process as far as you need to or want to or get value from. Now, just to touch on some of the basics from the previous Centrelink webinar. So to be eligible for the pension, you first need to have turned age pension age. That's based on your date of birth. And so check out your date of birth here and then your age pension age. That's at the age at which you're eligible. The maximum rates you could potentially get from the age pension, if you're a single, $926.20 per fortnight or $24,000 per annum. And a couple could get each, if they were both eligible for the age pension, $698.10 per fortnight or $36,000 per annum. Now, how the pension works is that you've got those potential maximums, the 24 or the 36, depending on if you're single or a couple. And then an income test is applied and an asset test is applied, and the lower rate of the two is the rate at which you'll get. So what happens when only one member of the couple is of age pension age? Well, it's the same income and assets test applies, so it's both couples' assets that are tested, and then the maximum rate they could get is that $698 per fortnight, or $18,000 per annum. So if only one of the spouses is of age pension age and the other isn't, then the maximum they can get is $18,000 for one spouse in the couple. So if the couple's income is on a fortnightly basis under $308 per fortnight or $8,000 per annum, then that's one spouse who is of age pension age would be getting the full age pension or $18,000 per annum. If you're over that threshold, so you're earning over, either earning or deemed to have earned over $308 per fortnight, then the eligible person, so the person of age pension age, their pension reduces by 25 cents for every dollar over that $308 per fortnight, to the point where if you earn on a fortnightly basis over $3,100 per fortnight or $80,610 per annum, there's no pension at all. That's the cut-off threshold under the income test. So you can have members of a couple, one's older and therefore and eligible for the age pension, one's younger and not. If that younger spouse or across both spouses you're earning less than $80,000 per annum, then there's a fair chance that the spouse who is of age pension age will get a part pension or potentially a full pension if it's under this $8,000 threshold. So we're going to talk through some strategies around that tonight. That's going to be the focus of tonight. Then we'll go into a couple of other strategies as well. And so the question that you've got to answer is, well, what is income? So we can work out how we reduce income. It includes your employment earnings, any salary sacrifice. It excludes the work bonus. So the work bonus is $300 per fortnight. I think I put the wrong figure in there. 7,800. I think it's 7,500. 300 times 26. No, it's 7,800. $7,800 per annum, or $300 per fortnight, is excluded under the work bonus, and then you could be earning up to another $8,000 as well. So you could be actually earning around just under $16,000 and still be receiving the full age pension. And then Overseas incomes included income from superannuation pensions, real estate, farm, and then deemed financial investments as well. That's what income is assessed from a Centrelink perspective. Assets that are included in the means test for Centrelink purposes. All vehicles and household contents, banks, real estate, antiques, collectibles, and also gifting as well. Assets that aren't included in the assets test are your principal home, that's on the same title, up to 2 hectares. We talked about that in the previous webinar if you want to go into the ins and outs of if you've got land larger than 2 hectares. An accommodation bond or RAD for aged care is excluded. Funeral bonds, prepaid funerals, and disability trust. So if you've got a disabled child, you can put a chunk of money into a special disability trust for them to support them in their living costs and housing, and that money is excluded from the income and assets test of both you, if you're the person who's gifted it, but also for the disabled person as well. James just asks, do assets include furniture in your principal home? That comes under, if I just flick back a page, household contents and personal effects. In the previous webinar we talked about Centrelink will assume your household and personal effects are worth $10,000, which includes your furniture in your home. If you don't put anything down, they'll assume $10,000. The value that you're putting on all your household contents is the fire sale value, so what it would cost to put what you would get to sell all your goods if you had to put them out on the street tomorrow and see what you got for them. So it's really a low cost fire sale value of those goods. We tend to say between $2,000 to $5,000 of those types of assets. So special disability trusts are unique if you've got a disabled child or family member. And then the part of the strategy that's key for tonight's session is this superannuation or rollover investment up until age pension age. They're excluded from the assets test. So if one spouse is younger and not age pension age yet, if they're holding money in their superannuation, it's not assessed as an asset. And this is a strategy that we apply regularly to boost the age pension of members of a couple where one member of the couple is of age pension age. So let's have a look at an example. We've got Sam and Sally, and they're 66, so Sam's 66 and Sally's 57. They're married, they live in a house that's worth $800,000. They've got $30,000 cash in the bank and $600,000 in a Christian pension. And they own $100,000 worth of shares. Now, as we mentioned, the home is excluded from the assets test, so that's not included at all in the testing. But what is included are their Christian pension accounts, the cash, the shares. So their assets total $730,000. How the assessment under the asset test works, and these guys will be asset tested, and that's why I've just focused on the asset test here, is that the lower asset threshold is $394,500. Assets over and above that are $335,500. You divide that figure by 1,000 and multiply it by 3, and you get the amount that their fortnightly pension will reduce each fortnight. If the maximum pension they could get is $1,396.20, then the maximum pension they could get as a couple is $389.70. But it's only it's only Sam that's eligible, so it's only half that they'll be eligible for. So under this scenario, with $730,000 of assets as a couple, and we're assuming that Sally's not working, neither of them are working, they get just under $200 per fortnight in age pension. So how can they improve their situation? How could they get more age pension? Well, their $600,000 in super was actually between 2 pension accounts. So Sam's got $440 in his Christian pension account, and Sally's got $160 in her Christian pension account. 100 of shares, 30 in the bank, and then Sally's got a Christian super account here that's dormant at the moment. So what we can do is take 200 of the 440 in Sam's Christian pension, Because he's over 60, if we withdraw that money and put it into his bank account, there's no tax payable on that. So we've just taken 200 from his pension account and put it into his bank account, or their joint bank account. With Sally, she's got, because she's in the pension phase of superannuation, even though she's underage pension age, that account is accessible from a Centrelink perspective. So to remove that from being accessible, we can roll that over to her Christian super accumulation account. And now, simply by rolling it over to that account, it's no longer assessed as an asset because she's underage pension age. And then we've got the shares. We could sell those shares and put the proceeds into the bank. And as we mentioned earlier, you need to factor in or make sure that you don't get hit by significant capital gains tax in selling those shares. But now we've got 330 in the bank, 160 in Sally's Christian Super and 240 in Sam's Super account. Now that money is no longer has anything to do with where it's come from now. It's just money in the bank. So 330 in the bank. That then could be contributed to Sally's Christian Super so that she's now got $460,000 in her Christian Super account. Although that $460,000 is now not accessible from Centrelink's perspective. So all that's accessible is the $240 over in Sam's Christian pension and $30,000 in the bank account. Now let's go through that again and see now how things are assessed. We've originally had them set up with 240 and we've now got the split between 240 in Sam's account and 460 in Sally's account. The home is exempt and Sally's Super is exempt from the asset test as well. So all we've got is the 240 in the pension accounts, 30 in cash and 270 total assets assessed. That's under the asset test threshold, and therefore there's no reduction in the pension under the assets test. They're also under the threshold at which the income test kicks in as well. So they'll get them, or Sam will be eligible for the maximum pension, which is half the $1,396. So he'll be eligible for now just under $700 per fortnight, which that totals $500 or $503.25 per fortnight increased pension. So that's about $13,000 per annum. And if that's factored in over 10 years at which Sally will be not eligible for the age pension, so for her age pension age 67, then that strategy can be applied for 10 years, and therefore there's a benefit of over 10 years of approximately $131,000. The pension will index up over time, so that figure should actually be a little bit higher, but I guess in today's dollars it's about $130,000 benefit over that 10-year period. So it's a really valuable strategy that can be applied. Just got a couple of questions coming through. June asks, what is one's principal home? Is a motor home? Your principal home is your home that you live in, is how Centrelink assess it. If you've only got one home, but you're living or renting somewhere else, it's not considered your primary place of residence, and from Centrelink's perspective, and it's assessed as an asset. And a motorhome is just assessed as another asset, like a car or other type of asset. John asks, what is the difference between Christian pension and Christian super accounts? Yeah, very good question. An accumulation account or a Christian super account is an account where you're putting money into the account. You're not drawing anything from it. A pension account is where it's just a separate type of account, and it's where you need to draw a minimum amount from it. So if you're between 55 and 65, you've got to draw 4% of the balance. If you're between 65 and 75, you've got to draw 5% of the balance. The benefit of being in that phase is that when you're in the pension phase of super and it's you've satisfied a condition of release, all the earnings on it are tax-free. If you're over 60, all the drawings on it are tax-free. So it's a very effective way to hold superannuation assets. In fact, what we normally target is people having their home owned outright with no debt, a cash reserve of 6 to 12 months living expenses, and then the rest of their funds in in the pension phase of superannuation. That's a great way to structure your retirement assets, except for when one spouse is under the age pension age and not eligible for the pension, where we apply this sort of strategy. Thanks for the questions there, June and John. So that's the nuts and bolts of the strategy. Feel free to forward questions about it if you don't quite understand it or I haven't explained it sufficiently. I showed this slide last time, but it basically shows the assets that you can have and still receive the age pension, or when you'll be asset tested and when you'll be income tested. So if we just pick a couple homeowner, which is this fourth column here, if you have financial assets less than $324,400, and financial assets mean that they'll be deemed. So if it's just all in superannuation, then it'll be deemed. But if you've got less than $324,400 of financial assets as a couple who owns their own home, you'll receive the full age pension. So that's the $1,396 per fortnight if you're both eligible. After you get over that threshold, you'll start to be asset tested. So in the range 324,400 to 411,500, you'll be asset tested. And then the point at which you'll come off you're not asset tested. So you're not tested at all. You got the full pension is the blue bit. So you're income tested up through until 411,500, and then you're asset tested in this grey section up to 860,000. Once you've got assets over $860,000, then you get no age pension. So this is the interaction between when you're income tested and when you're asset tested. So the blue bit is the full age pension. The orange bit is where you're income tested, and then the grey bit is where you're asset tested. Just gives you an idea of the level of assets you'll have and when you'll be, or how you'll be tested. So once you know that, once you know what your assets are and which method you're going to be tested under, you can then start to think about strategies that can potentially apply. Just relating to that strategy is often it's difficult to understand where the money is going to come from. So you're both, in this case, Sam and Sally are actually both retired. We've just put a whole heap of assets, and this might relate to John, your question, the difference between the pension account and the accumulation account. We put a whole lot of assets over into Sally's super. Now, you don't draw anything out of your superannuation fund, your accumulation fund. It just continues to tick along and grow. Whereas this pension account over here, we've got to draw, because Sam's between 65 and 75, he's got to draw 5% of the balance, or $12,000 per annum. But under this current structure, they're getting $18,000 from the age pension per annum, and then they're drawing $12,000 from Sam's Christian pension account. So that's the minimum that they must withdraw. They got full ability to draw as much as they like. And then, so their total income is $30,000 per annum, but that's potentially not their full income requirement. It's more likely to be around the $50,000 threshold. A comfortable retirement is actually $60,000 for a couple who own their own home. Under the ASFA survey, but everybody lives differently. But to get the extra $20,000, we can, in the first year, we've got $30,000 in the bank that they could use, so that can be drawn down until they've sort of got a cash reserve of $10,000. But after that, often what we can do, because Sally has retired, she's not working, she's effectively retired, she's got full access to this money in her super, and so she can draw lump sums. It's not a pension payment, but you're drawing a lump sum amount. So this, we're suggesting that she could draw $20,000 from the super account, put it into the bank to replenish it to $30,000, and then, so that's effectively how we're able to get the annual expenditure up to the $50,000 income requirement that they have. Now you can do that for the 10 years, so another $20,000 can be drawn out the following year, and then she can continue to do that up until the point at which Sally turns pension age, so 10 years later in this case. And then the best thing to do is then roll this accumulation account back to the pension phase. And the reason for that is that you can then start to draw a regular pension, either either twice a month, once a month, quarterly or annually, to then pay for your living expenses at that point. So the $20,000, rather than being drawn down as lump sums from the Christian super account, it'll be automatically paid out as a pension payment from Sally's pension. And the other reason why it's good to move to that is that there's 0% tax on earnings, and if Sally's at that point over 60, there's no tax on drawings as well. And what we often try to do as well is enable or clear the tax components, so that if either Sam or Sally died, there would be no tax payable by their kids as well. Now, that's called a cash-out recontribution strategy, and it was the third webinar in the retirement planning series, which is available at cornerstonewealth.com.au/retire 2019. So that's how the strategy works. It involves putting assets in the younger spouse's accumulation account and then drawing lump sums from that account to provide for your income needs over that time. There is a bit of complexity with the strategy, and so just to highlight some of these for you if you're considering the likes of this strategy. We mentioned that Sally in this case is retired and has finished work. If she's under 60, so for her to fully access her superannuation money to make those $20,000 lump sums each year, she needs to have retired and specified that she doesn't intend to return to the workforce. If she hasn't done it, if she's still working, maybe she's earning 20 grand a year in employment income and hasn't ceased work, then she's not satisfied a condition of release, and she probably can't get access to that $20,000 lump sum each year. So you just need to factor that in and think about, well, yeah, fair enough, it's a great strategy. We can get an extra $13,000 from the government each year. But are we going to actually be able to pay for our needs? And if there is a concern, there's a couple of strategies around it. One, you could just draw down more from Sam's pension account. So rather than drawing $12,000 a year, you could draw $30,000 a year. So in 10 years, you've potentially utilised all his funds. Or you might keep further funds outside. So if you've got shares outside, you might use those to fund your ongoing living expenses. But it's an important factor that if you haven't satisfied a condition of release, or the younger spouse hasn't satisfied a condition of release, it's not. You need to work out how you're going to meet your cash flow requirements on a regular basis. The other thing is, we've mentioned that there's a benefit in this scenario of $13,000 per annum. There is a drawback of the strategy, or a slight drawback, in that in the accumulation phase of superannuation, there's 15% tax on earnings, whereas in the pension phase that she was in before Sally was in before we applied the strategy, there was no tax payable on earnings. So we can estimate what that might be. So she's got a 460 in super. If that earns 5% per annum and is taxed at 15%, she's potentially paying an additional $3.5 grand tax that she didn't need to pay when she was in the pension phase. But overall, even after the $3.5 grand, she's still around $10,000 better off by applying this strategy. So whilst it is a bit of a drawback on the benefits of the strategy, she's still a lot better off applying the strategy than not. So to the tune of, say, $10,000. But it is a factor, and we sometimes find that we don't apply the strategy if the assets are so high that, so if this was double this amount. It was more like $920,000. Then it's going to be $7,000 of tax that they're potentially paying, and so it reduces the benefit of the strategy back to $5,000 or $6,000. Still, you'd probably still do it there, but there are scenarios where we didn't apply it because the tax within the fund meant that it negated the benefit that was available to them. Factor in the asset test threshold as well. So the asset test threshold is $394,000. So to be eligible for the full age pension, you need to have assets less than that. But there's a deeming on financial assets that mean that, and this relates back to that chart on the previous page. So you need financial assets of less than $324,000 to be fully, as a couple, to be fully eligible for the age pension. So that might mean that you've got $324,000 in SAM superannuation in this instance, and you might have $100,000 in a motorhome. Not $100,000. You might have $50,000 in a motorhome, but because that's still under the $394,000, you're under the assets test threshold, and you're under the threshold at which the income test will impact your pension, so you'd still get the full age pension. John's just asked, the scenario of drawing down $20,000 per annum means Sally's super fund has been exhausted by the time she reaches pension age. You would ideally not be in that scenario, because on a $460,000 account, you would be ideally earning 5%, or what's that, $23,000. So the earnings on the account should cover the drawings in that instance. That's generally how that would work. And so you'd still have the assets, depending on what risk you're taking in your portfolio, you'd still have the asset there at the end of the 10-year period. The other thing to factor in is capital gains on shares. So I think we had $100,000 of shares that we sold, and then we put into Sally's superannuation. You just need to factor in the tax there. If there are tax on the assets that you're selling, whether it's shares or sometimes it's an investment property, there are some strategies that we often apply to reduce capital gains tax. They have been enhanced this last financial year because you can do what we call carry forward deductible superannuation contributions. So if you didn't put in any super contributions, or what we call concessional contributions, in last financial year, that's a $25,000 threshold that was available to you that you haven't used. You can actually bring that forward this financial year and make a $50,000 deductible contribution, which can significantly reduce capital gains tax. So if you are triggering gains into the future, you potentially might be able to take advantage of those sorts of strategies. And the other thing is that there are contribution limits. So there's a $300,000 contribution limit. So we set the maximum amount in Sally's scenario. We worked it out so that there was $300,000 of assets that we could make as a contribution into the super, and we rolled over the $160,000 from her pension account. The reason why we rolled it over and didn't withdraw it is because it didn't have enough contributions capacity to cash it out to the bank and then contribute as a non-concessional contribution. So the annual limit for contributions or non-concessional contributions is $100,000, but if you're under 65, you can bring forward 2 years to make it $300,000. And so you just got to be aware of that limit as well, of how much you can get into the younger spouse's super. And then there's the cash out recontribution strategy. I'll talk about that again in that third retirement planning webinar that's available at cornerstonewealth.com.au/retire 2019, where what we're trying to do is maximise what would go to your beneficiaries in the event of your death. And the way that we do that is cash out your super money and recontribute it. But this is we often combine the cash out recontribution strategy with this maximising the older spouse's age pension entitlements by cashing the funds out and then contributing it into the super. It clears those tax components for your beneficiaries' purposes. So a little bit of complexity there, but as you can see, there's some significant benefits, like $100,000 over 10 years is a good, is a good solid benefit. But it depends on how what's the age difference between the two spouses in the couple. If it's a short period of 6 months, sometimes it's minimal benefit for the effort. But if it is a longer period of time, then it works well. Scenarios where it sometimes doesn't work well is that if, it doesn't work at all, is that if the younger spouse or both spouses are still working and they're earning over the $80,000 income test threshold. That's often the hardest one to manage. It's easy for us to manage where both spouses have retired, but it's difficult for us to manage it's more difficult where either one or both spouses are still working, because they're already reducing the age pension due to their levels of income. Let us know if there are any questions there. So I'm just moving on from that strategy, which is about maximising the age pension, where one spouse is eligible for the age pension and the other isn't. And now moving into this second strategy, which is about maximising the age pension when one spouse passes away. And I've discussed this with many clients, but I've only probably implemented it with less than a dozen. And the reason is it's a hard conversation to have, because you're talking about death and trying to plan around death. But what happens when one spouse passes away is that you change from being assessed under the couple's thresholds to being assessed under the singles threshold. So you might have been eligible for a full or part pension as a couple, but if one spouse passes, you might then reduce your age pension entitlements to either nothing or significantly reduced, just because you've got a different income and assets test threshold as a single person. And you also may lose the benefit of the healthcare card. So the idea of these strategies are to forward plan a little bit so that you don't miss out on either age pension entitlements and you don't miss out on the healthcare card in the event of the death of one spouse. So let's look at an example. It's probably easiest to talk through an example, and then we'll look at the complexities of it. So we've got Joe and Mary. They're 77 and 68 years of age. They own their own home that's worth $600,000. They've got a joint account with $50,000 in it and Christian pensions with $550,000 in it. Again, the house is not assessed for Centrelink purposes. Joe has $200,000 in his Christian pension account, and Mary's got $350,000 in hers. Cash in the bank, so their total assessable assets are $600,000. The lower threshold for the couple who own their own home is $394,500. And the assets over that threshold are $205,500. Divide that by 1,000, multiply it by 3, and this is the amount that their age pension entitlements had reduced due to their assets being assessed. So their 1,396 maximum reduces down to 781 per annum. Now that's whilst they're both still alive, and then in the event that one of them passes away and they've got their assets being directed to each other, normally that's a common thing to do, because you want to support the surviving spouse. So generally there'd be a binding death nomination on or a reversionary beneficiary on these accounts, and it would just go to the surviving spouse. So under a single person's, so one spouse has passed away, under the single assets test, the assets that are assessed are $600,000, but the lower threshold then reduces to $281,000 because it's under the singles test, not the couples test. And so the assets over that threshold, $309,000, that reduces the pension by $957 per fortnight, which means that the pension actually reduces to nil. There's no pension payable now for whoever survives, whether it's Joe or Mary. And so they've probably got sufficient assets to support themselves now as a single person, but they might eat into their assets a little bit over time. But you could be generating at 5% $30,000 to live on. If you need to draw another $10,000 or $20,000, you might eat into the capital a bit, but the surviving spouse would be comfortable. But you could potentially direct one of these pension accounts to kids. So you could set up a nomination or a binding nomination to direct either one of these accounts to the kids. We've said in this first instance that it is Joe that's passed away, and Joe had his super money, his $200,000, directed to the kids, not to Mary. And in that case, that's no longer assessed. So the $200,000 is no longer assessed. It's now gone to the kids. It's no longer Mary's. And her $350,000 plus the cash in the bank totals $400,000. The lower threshold is 281. The exceeding assets are 119. So the pension is reduced by not 957 but 357, which means that she'll get a pension of $569.20, which is a lot better than no pension at all. If there wasn't a binding death nomination to the kids and it was just left to Mary, if she then said, well, as part of the wrapping up the estate, I'm going to direct that $200,000 to the kids, it would be caught in gifting rules, Centrelink gifting rules. So she'd still be assessed like she holds the asset or the majority of the asset. But if there's a binding death nomination sending it to the kids, then it's nothing to do with Mary. It's gone to the kids, and you can be assessed in this way. Now, just to give you an idea what would happen if Mary passed away rather than Joe, and Mary's account of $350 was directed to the kids. And it just gives it's a larger amount going to the kids, and therefore lower assets test of it's only $250,000 of assets that is accessible, and that means that he then gets the full age pension. Actually, he doesn't get the full age pension because he's in a threshold at which the income test will apply, and so rather than getting the full age pension, he will have a slight reduction back to $888.88 because he now falls under the income test, just with the level of assets that he's got. But you can see here that it can actually both benefit your kids and it can benefit the surviving spouse as well, because they're getting a significant amount of money from the government rather than having to eat into their assets, which will then mean that there won't be as much passed on to kids. But the thing that you need to factor in, is there enough here in where Joe's the surviving spouse with $200,000 in the bank, $200,000 in super and $50 in the bank, so $250,000 of full assets for him to live on. So it's he'd be getting nearly $900 per fortnight, but he might need to top that up with money from his superannuation. And the question that the tricky bit about this strategy is knowing how much you need to support yourself longer term. And it's sort of indicative here that Mary's got $400,000 that she can use to support herself long term, and Joe's only got $250,000. So Mary's probably going to be pretty comfortable, but depending on how long Joe lives, he might eat into his capital and then just be fully reliant on the age pension. So you need to factor those in, but it can have great outcomes for both the surviving spouse who gets to maintain the age pension, and you're also benefiting your broader family by passing on assets to the next generation. And you're also maintaining the healthcare card. But the key thing is couples that this has been implemented for, or that we have helped implement it for, have generally been older, and therefore you've got a shorter life expectancy, and therefore it's a lot more predictable about how much asset you'll need or to support yourself over and above your pension entitlements. But there's a significant difference between the two options. So where Joe passed away, Mary was getting just about $15,000 in age pension entitlements, but when Mary passed away, Joe was getting about $23,000 in pension entitlements. So you've got to have sufficient other assets to get your income up to the level that you need it to be. I think a comfortable retirement for a single person is around the $40,000 mark, maybe a bit higher. So yeah, you need to have sufficient assets to top up those to provide for your income needs. Then there's the healthcare card benefits. So if you do maintain an age pension, there's the healthcare card benefits, including discount rates, registration, utilities, license renewal, and that can add up to, depending on what your arrangements are, it could be sort of $500 to $2,500, depending on what the what your particular expenses are and what your state discounts. Yeah, but the key thing is, do you have sufficient funds to live on? And that's the big unknown that prevents people from applying the strategy. Another one is that we've touched on, and it goes into a bit more detail in the cash out recontribution strategy on that third webinar in the retirement planning series. It's about the taxable components in your fund. If your superannuation fund, or if Mary's fund, sorry, I've gone back to these, but if for example, Mary's account was all taxable components and she passed away, she'd pay 17%, and she directed it to the kids, because they're not, if they're adult kids living independently, they're not financially dependent, they might pay 17% tax on those components. And so it's ideal that you have your superannuation money in all tax-free components if you're going to apply this strategy. Yeah, that's a bit tricky. So yeah, be careful of those death benefit tax, and ideally have all tax-free components in your super fund if you're setting up the strategy. The other question is that you need to make sure that you've got sufficient funds for a potentially refundable accommodation deposit. But in excuse me, sorry for sneezing in everyone's ear. Yeah, you've got to make sure that you've got sufficient funds for a refundable accommodation deposit. But in this scenario, if there's a surviving spouse, that spouse could sell the home to fund that deposit anyway. So it's not a massive deal in this situation, but you just need to make sure that you do have sufficient funds to fund it. And then there are potential unknowns around changes to the income and assets test. If we're planning it now, and it doesn't happen for 10 years and you haven't reviewed the strategy, then there might be some quirk or change in the income and assets test that means that the strategy isn't applicable or doesn't work in the future. But yeah, definitely something that it can really be of benefit. David's asking, hi, would there be a different strategy for Mary if Joe passed away and left the super pension to the estate and to Mary as a life estate, that is for her to use but not keep? Yeah, I think if she, it all comes down to who's got control of the asset. So if there is no control over so it's effectively saying that you're setting up a trust for Mary to benefit. So you're setting up a testamentary trust within the will that Mary will benefit from the earnings on the account, but she'll be able to access the earnings but won't be able to access the capital. It is a strategy that can apply, but I think You just need to be careful about it, but it could actually work if she doesn't have control over it. If she had any sort of control over it, if she was set up as the trustee or anything, but if there were kids potentially set up as the trustee and she would just benefit from distributions, then yeah, that could potentially work. I'm just trying to remember how the income is assessed. Yeah, I had a scenario of it just recently where we've set it up that way, but it was around the house, not around the superannuation, but it's a similar sort of concept. But yeah, it could be another way of thanks, I'll consider that further, a bit of work to work through. Yeah, so just look through it. If that's something that applies to your particular situation, I haven't seen it applied or haven't had it talked about as a way of structuring it. Yeah, but that you could potentially review it and see whether it actually got a similar result, but maintained the income coming through. To the surviving spouse. Yeah, I'd have to check it out. Yeah, but good point. Any other questions about how to maintain access to the age pension in the death of a spouse? Just let us know before we move on to the next section. This just revisiting, thresholds, etc. We talked about that before. Just some other basics of asset test reduction strategies. So, if you are asset tested, if you are in this range where you're in this grey range, so if you're a couple homeowner and you've got assets between $411,500 and $860,000, you're asset tested. That means your pension will be reduced due to your assets. So how do you reduce some of your asset values? Some basic ones are update your assets listed with Centrelink. So if you've generally, at least annually, your car should have gone down in value. Even if you haven't driven it, it generally goes down in value, unless you're driving some classic car or something. But generally the car will go down in value, so revalue that each year downwards. You might have other assets that you can reduce in value, like motorhomes. They generally would lose value over time. So if you're constantly adjusting your asset value down and you're asset tested, you can actually increase. So for every $1,000 that you're reducing your assets, if you're asset tested, you're getting an extra $78 per annum in age pension. If it's $10,000 that you're reducing it by, that's $780 per annum that you're increasing your pension by. The other way to do it is you can spend money. So you can spend money on house improvements or your holidays. Because your house is excluded or exempt from the asset test, then anything that you spend on the house reduces your assets tested by Centrelink and can increase your pension. Spend it on a holiday and then the money's gone, and therefore it's not assessed for Centrelink purposes. But with those types of strategies, you've got to look at the pros and cons, because the money's there, no longer there available for you to use either. So it's not just all about let's go spend all the money and have nothing left, because generally you need cash reserves to top up the age pension. Not many people live on the age pension not many people want to live on the age pension only. They generally want to top it up with some other funds as well. You can gift money. So we talked about gifting rules in the previous webinar. If you want to look into that in a bit more detail, then check that out. But you could gift $10,000 a year or 30 over 5 years, and it will reduce your assets, and you won't be penalised by it. If you do over those thresholds, then the amount over that threshold will be assessed for 5 years, even though you haven't got it and aren't earning any money on the amount that you've gifted. But again, gift $10,000, you might be getting, let's say the money's in the bank, you're earning 2.5% on the $10,000 or $250. You could gift it and you would increase your pension by $780, so that's a lot better than the $250 that you might get in the bank. So you can apply those sorts of strategies. Super for spouse less than age pension age. that's what we've just talked about, that previous strategy, so we don't need to go into that any further. Some people like to take out funeral bonds and prepaid funeral expenses. They're probably not the most advantageous investments, but sometimes you can sort of lock in your cost of a funeral, and if you're reducing your assets, you're effectively getting let's say it's $10,000 for a prepaid funeral or a funeral bond. Because they're no longer assessed again, you might be increasing your pension by $780 per annum. And then the other one is an annuity with a residual capital value of less than 100%. We might just touch on that because that's a strategy that has recently changed, and so we'll look at it now. Yeah. Let us know if there's any questions about those previous ones. But firstly, what is an annuity? There are various types and there are various conditions associated with them. So some are focused on helping aged care outcomes. Some are just short-term alternatives to term deposits. But what they are is effectively a source of income for a defined period. So generally, and it's not subject to market movement. So your money in Christian Super, it goes up and down based on what the market is doing, so what the underlying investments are. So I just got distracted. I hadn't had the Q&A open, so apologies to John, Greg and John about your questions there. I'll just quickly cover those off. Are caravans assessed in a similar manner to cars? That is the market value or what you think you might get on a sale to a dealer? Yes, that's correct, John. We generally, for cars, use Redbook and use the lower end of the trade-in value on redbook.com.au. Greg is just asking, is transferring an investment property fully into my spouse's name going to help? No, it isn't, Greg. It's only if the asset's held within superannuation. If it's held in your spouse's personal name, it doesn't. It's still tested as an asset. And John says, income and assets test, are those numbers indexed or changed periodically by legislation? Yes, John, those thresholds that I showed before in that bar chart, they're changed all the time. They actually have recently changed with the deeming rate change, actually. So we've just updated them with the changes resulting from that legislative deeming rate change. Sorry I didn't answer your questions earlier, just hadn't had it open. And then Robin says, do we have access to a copy of the PowerPoint? Yes, so we'll send through a link. It'll be on that page, cornerstonewealth.com.au/retire 2019. Getting back to annuities. Effectively what you're doing is giving over a chunk of capital, and the life insurance company is committing to pay you a certain amount over time that's not subject to market movement. And it can be used to complement the age pension or investments like account-based pensions that are like Christian pension that is subject to market volatility. It can have some social security benefits. And the way that so there are two main types of annuities. One is the term annuities, where it's for a fixed term, so it might be 15 years that you'll get paid a certain amount, and then you can choose the amount that you get paid at the end of that 15-year term or other term that you choose. And then there's lifetime annuities that will just be paid throughout your lifetime until you pass away. They're the two broad types of annuities. And how they worked previously was that the benefit they have from an age pension perspective is that you might say have $100,000 that you've given to your life insurance company, and they've committed to pay you an amount each year. It might be around $6,000. There's a deductible amount for example, there might be a deductible amount of $6,532, which means that if they're paying you out of that $100,000, they've committed to pay you for the rest of your life $6,500, then it's not going to impact the Centrelink income test, and then the asset is also going to reduce each year down to the point that in 16 years it's going to have no asset there, from a Centrelink perspective, so there won't be any assessment on the $100,000 original investment. There'll be no assessment, but you'd still be getting the $6,500 being paid out, and it wouldn't be income tested either. So that's the benefit they do have. The drawback of them is, and there's lots more options out there, but the perceived drawback can be that you sometimes can't draw out lump sums. So if you decided to you wouldn't put a lot of your money into it. Generally, they say up to a quarter or a third of your investable assets, because you want to maintain access to some capital to draw down funds. But one of the main benefits is that it can enhance your Centrelink outcomes by utilising them. Here's a quick example. I know I've only got a few minutes left before 9:30. But Joe and Sarah, who are 67 years of age, they own their own home. They've got 250 each in their account-based pension, so that's like a Christian pension. So 500 in total. They've got a 50-50 risk profile, and they've got 20 in personal assets and 50 in cash. They're entitled to the combined age pension of 22. This is on old rates, so this is an old slide, but similar sort of things have applied. So $20,000 per annum under the assets test, and they require income of $60,000 per annum. So if they took out $150,000 from their respective superannuation accounts and invested it in $75,000 each in an annuity, which gives them $8,400 per annum in payments, they'd retain $175 in their account-based pension, giving them $29,000, and then the age pension would be giving them $20,000. So they've effectively just click through the wrong thing again. They've effectively achieved their income requirement of $60,000 per annum. So the 20 plus 30 is 50 plus another 16. Lifetime annuities plus another 8 is pretty close to their $60,000 income requirement. How that looks is that this is the age pension entitlements. Sorry, this is not the age pension. The blue bit down the bottom is the age pension that increases over time as less of the $150,000 is assessed each year. It boosts the age pension each year. This lifetime annuity bit is the constant payment that underwrites your ongoing income requirement, but it's the Christian pension account here that's providing the boost over and above that figure up until, and this red line here is their 50% chance at age 67 that they'd reach 93 years of age. So in that scenario, they're actually meeting their income requirement by having this annuity here supporting their income. What the alternative is that you don't take out the annuity and your age pension because you're getting less age pension over time. You're eating into your Christian pension a little bit more, which means that you might fall short a little bit here. But it is all dependent on what earnings you assume in your age pension. When I've reviewed this on a number of times, all you needed was like a 4 to 4.5% return on your superannuation money, and you were going to outperform the benefits of the annuity. Now, that's the old style of annuities. Did you say that annuities are not considered as income? Why not? So that was James, just to clarify, that was the old rules. This deductible, I won't go back to it because I'll have to go through all the slides again, but there's a deductible amount which basically says that any income from the annuity less than the deductible amount is not assessed as income. That's just the rules to encourage people into these sort of retirement income streams. But there is new legislation that has started from the 1st of July, and I haven't got an example of it like the previous one yet. But the way that these work, if you satisfy the declining capital access schedule, which means that if you put $100,000 into the annuity and you've got less access to capital over time in line with their schedule, then it'll be income tested at 60% of the payment. So if you're getting paid 10 grand a year, then 6 grand will be assessable under the income test, and nothing will be assessed for the deferred life, because you can take out an annuity and choose not to have any income for, say, 5 years. There'll be nothing assessed during that 5-year period. And then under the assets test, your purchase price will be assessed at 60% of the purchase price. So you can reduce your assets straight away by purchasing an income stream, lifetime income stream that are in line with the rules. So you might spend $100,000 on it, but your assets immediately will be assessed at $60,000 under these rules. If they don't quite match the rules, and then it's for a minimum of 5 years and then 30% thereafter, so it actually reduces another amount 5 years on as well. So they're really trying to be creative about different types of income streams in retirement to try and underwrite longer term pension payments required for people to live on in older life. But these are the new rules, and sort of, it's not a very clear slide, but basically what it's saying that if you invested an amount, a lot of this is looking at a Challenger lifetime annuity with monthly payments for a 65-year-old female, but the actual product will pay a death benefit for, say, I think it's a 12-year period, is it? But the maximum voluntary withdrawal, so if you die, you'll get the purchase price back for the first, I think it might be 10 years, and then, but the maximum voluntary withdrawal, if you choose to just withdraw the funds, you can do that, but it reduces over time. And so this is a particular product, and then you'll get these pension payments indexed up at over a period here. So it's kind of showing how a product might work, and you get the benefits of the 60% testing under the asset test and income test. So it is an option, but you're reducing your flexibility. But if it's combined with if it's only a small portion of your total investments, and it's combined with other assets, then it can be a way of reducing your income and assets test to boost your age pension. You've got to weigh out the pros and cons, so there's limitations of what you can draw out. You're locking in for a fixed level of return. When the market's record low interest rates, sometimes that can be perceived that if we then had a big upswing in interest rates, you might be locked into an annuity that's at a reasonably low return figure, and then over time you might be better off if you were in a market linked, like a Christian pension type account as well. And it was about, the ones that I've assessed, it was about 4 to 4.5% return provided a better outcome. And then that's, I mentioned the interest rates. I'll just quickly run through. Actually, I might skip over these last couple of slides. There's asset test changes that I won't go into. So we've hit 933. There's a deeming of pension changes that happened back in 2015, 1st of Jan 2015. If you had a pension in place at that point in time, just consider whether you might want to keep that rather than rolling it over, because it can impact your assessment under the Centrelink rules. I don't have the scenarios where we've reviewed this particular issue. It hasn't actually been an issue, and particularly with the deeming rates dropping, it hasn't been much of a concern. But if you have got an account-based pension that you started before Jan 2015, just consider whether you want to keep the old non-deemed account rather than rebooting it, because it can have some impacts. But we've just run out of time, so I'll open up to questions. If you do have questions, feel free to ask them via the chat section. I'll walk through them as we go. Otherwise, thanks very much for attending. If you would like to tap into those previous webinars and the slides, they're available. All the other 4 webinars and slides are available at cornerstonewealth.com.au/retire 2019. You can see those now. The next webinar is not tonight. There's not going to be another webinar this year, I don't think, that I'll be conducting. But the recordings of the other ones are available. If you would like financial advice from us, then there's the website or our phone number, 1300 275 428. Christian Super is also able to help, either the phone number or the website. And then if you've got member online access with Christian Super, then there is a sort of a robo type of advisor type and some calculators that you can use called Super Equip. You might get some value out of that. And then there's Centrelink as well. So if you've got questions about this sort of stuff, there's lots of information on the humanservices.gov.au website. You can call them if you're prepared to wait online for a bit. And then a financial information services officer. That's free consultations with the Centrelink's advisors that you can gain more information from them. So the likes of David about that estate question, if you were serious about pursuing that, then you could meet with a financial information services officer and just talk that through with them. They can generally answer those types of questions. So do shoot through your questions. I think I'm covered currently with all the questions that are up at the moment. I could get a bit adventurous, and if you wanted to raise your hands, no worries, David. Thanks for your questions. James says, did you say that annuities are not considered as income? Why not? Oh, that was a question from earlier, sorry. It's just the rules, as I mentioned earlier. I was thinking of getting adventurous and opening the lines up for people to ask questions, so I'm not sure if I've done it on this platform before, but I could give it a go if you wanted to raise your hand, for example. I think there's a mechanism that you can raise your hand. If you want to ask a verbal question, then feel free to give it a go. And I'll see if I can open your line to ask a question. Linton says, I came in late, can I hear this again? Yes, it'll be up on, normally take a couple of days to get the recording sorted, but it's available on that website, cornerstonewealth.com.au/retire 2019. I'll send out an email as well with the link when it's available, but you'll be able to access it most likely by the end of the week. No worries, Linton. Marie just saying thanks, been very helpful. Thanks for joining us, Marie. Appreciate the comments. Ian, thanks. Thank you. It's helpful. Pleasure, Ian. Glad you benefited. Wondering about adding question for later. So John, we're wondering about adding money to super from savings after retiring and being over 65. That is upcoming changes in legislation. The legislation already, one of the legislative changes, John, that's implemented already is if you can put money into super the year after you retire, if you are over 65 years of age. So I'm not sure if you worked last financial year and then that rule could apply. There is a limit of 300 in your super for that to work. It's the same question. And then Ian, we are both 62 years of age. To have an annual income of 60k, where would we be now as far as superannuation and other cash? 62. Because you're largely going to be self-sufficient, it's kind of the 12 times rule, but that assumes an 8% sort of return. But if you're 62, you're not getting government support, and if you don't want to eat into your capital, then it's sort of a 5% return that you'd be aiming for, which is like the $1.2 million. But you might be able to eat into your capital a little bit and be able to, then if you've got less than that, you could eat into your capital, and then the reduction in your capital over time will slow down as the age pension kicks in. But it is ideal if you can generate some income, some part-time income, because it does significantly reduce the having a part income reduces the amount that you eat into your resources. Should not would. Not quite catching that, Ian. Robin asks, if still working and 66 years of age, or 66 years old, should I do anything with my super funds that is all available? Yeah, if you're not in the pension phase, then it's worth being in the pension phase generally, because you're moving from a 15% tax environment to a zero tax environment, Robin. Vicky says, if downsizing a family home, what are the best things to do with the surplus funds? Sorry if this is a repeat question. What was covered previous webinars, as I couldn't make these. No worries, Vicky. There are downsize legislation if you are over 65 that you can put up to $300,000 each into superannuation. Generally, that's what we would be doing with it, under that principle that it's a great way to structure your assets by owning your own home outright, having a cash reserve of 3 to 6 months living expenses, and then the rest of the funds in the pension phase of superannuation, and ideally tax-free components. Under that sort of structure, we're generally putting surplus funds into the superannuation environment and rolling it to pension phase. But yeah, you need to check your particular circumstances and whether that's suitable. And Sheila says, this was very informative. Thank you. Is it possible to access previous webinars referenced tonight but not registered for? Yes, they're all at that website, Sheila. So cornerstonewealth.com.au/retire 2019. They're available there now. Just a few other questions. Barbie says, thanks, Gavin. Have to go. Barbie, pleasure. Thanks for joining us. And John, thanks. Bye. Thank you, John. I might get an answer to the other question one day about gifting, etc. And Sheila, thank you. Pleasure, Sheila. Well, if there's no other questions that come through in the next little while, I don't think anyone's put their hand up, but I'm not sure because it doesn't look like they have. So thanks again. Angela's saying thanks so much. Very helpful. A pleasure, Angela. And yeah, really appreciate the interaction. I hope you've benefited from it. Thanks so much for joining us for the webinar. And let us know if we can help further in the future. Thanks again. Good night.